One of the big trends in the post-COVID world was this massive uptick in M&A activity. But obviously now, with the market starting to change and financial conditions changing, things in the M&A space are also starting to change. So I wanted to talk to LSEG's Matt Toole about what these trends are, what's driving them, and where we think they're going to go over the next 12 months. Hi, Matt, and welcome. And today, I'd love to talk to you about the world of M&A because obviously post-COVID, it really picked up, but things are changing, starting to change a bit with obviously the changes in the market. But before we get to that, could you maybe just give an update on the landscape and what we've been seeing really over the last 2 years of 2020 and 2021 in terms of the big trends?
We saw a really elevated M&A market coming out of the pandemic, which I think surprised many of the advisors and boardrooms and CEOs who expected probably a little bit of a more prolonged downturn after quarantine in the spring of 2020. But we came through the end of 2020 into 21 with 8 consecutive quarters of $1 trillion or more in M&A activity, with double-digit increases across regions, nearly every sector. A number of sectors really kind of focused in on particularly technology and really seeing a lot of technology activity over the last 2 years. But a lot of corporate deal making activity as companies took advantage of market conditions, but also rethought their business model post pandemic, potentially bringing in more supply chain activity. Actually acquiring companies in their supply chain, seeing ways to expand geographically, or moving into adjacent technology areas, particularly in the areas where we saw a number of large technology transactions, but then also tech adjacent M&A activity. And that really drove us to all-time records. We saw almost $6 trillion in M&A last year, which will be probably one of the highest ever, as we look back over this time period.
And I guess things are changing. It feels like we're in a different world today than we were for the last 2 years. What are the big changes that you've been seeing in this landscape, really in 2022?
I think as we began the year, we did still see some confidence in M&A activity, and I think a lot of corporate deal makers felt that there still would be a number of attractive conditions. But we have seen things change pretty dramatically. Certainly, the overall kind of confidence of the market with stock market indices around the world seeing some pretty sharp declines over the last 6 to 9 months or so. Inflation certainly becoming a big factor. Interest rates rising. Certainly, Federal Reserve and central banks around the world looking to combat inflation and other parts of the market where interest rates have a big impact. And so that has really put a damper on M&A activity, where we saw, the third quarter of the year, we saw the first quarter below $1 trillion since the pandemic, and many of the indicators of corporate confidence, kind of not really pushing M&A activity to levels that we might have expected. So it has been pretty broad-based across industries. We're seeing the largest year-over-year decrease since 2009, since the financial crisis, and I think there's some really indicators, some strong indicators that is going to continue, particularly as corporate boardrooms are still trying to figure out kind of what the outlook for M&A is going to be, but also private equity, which has been a really big part of the last 2 years. Their financial equation changes as credit markets change, and so private equity having to put in more cash, obviously very, very beholden to the corporate bond market and the lending market. And as interest rates change, the quality of those offerings is going to be coming into focus, and certainly the financial equation on how private equity gets their returns changes as it gets more expensive to finance those transactions.
And just touching on that bit in terms of financing, obviously some deals are done deals, but some deals were in the process of going through the motions. Now, has this rapid repricing of the rates market meant that some deals that hadn't got over the finishing line are still basically stuck in limbo or maybe won't go through? Is this change in interest rates having a big impact on existing deals that have sort of been pre-agreed?
We're certainly seeing some shakiness in that market for just general corporate bond activity, but certainly transaction and M&A related activity. We've saw a number of deals in the market as we moved into this kind of different environment over the last 3 to 6 months. Announced earlier in the year with some financing activity, which is no longer as attractive as it may have been. Investors demanding kind of different terms and conditions for different credits, and so we saw Citrix, for example, trying to finance a $16 billion LBO a couple of weeks ago, having to really make some pretty dramatic changes on how the banks were able to sell that offering into the market. Just last week, an Apollo-led financing package, collapsed bond and loan transaction, having to rejigger that transaction, Apollo having to put in some more cash and tap some additional sources of credit. So, I think those deals that are in the market right now, the terms earlier this year have changed, and I think many of the the underwriting community, the banks, and certainly the names and the corporations involved and the private equity firms involved are rethinking how these deals might be able to successfully close, or thinking if they might have to actually withdraw the transaction, which we've also seen a pretty pronounced uptick in canceled and pulled deals this year as companies just decide to walk away.
And whilst obviously there's issues, are we seeing some of the dislocations having impact on some of the geographical volumes? Because presumably with some of the big moves in asset prices and currencies that we've seen, it's changing maybe the geographical landscape of acquirer and acquiree.
Cross-border M&A has always been a real hallmark of pronounced and elevated M&A cycles. And we did see that over the last 2 years. But it also can change pretty dramatically based on what borders you're talking about. So I think some of the currency changes that we've seen with the euro at near parity to the dollar, the very strong move in the pound over the last number of weeks, making some of those assets much more attractive. We've seen, over the last, probably 2 or 3 months, some pretty pronounced activity into the UK from Europe. It traditionally is a pretty strong M&A, kind of partner for many cross-border transactions. We saw a lot of US, UK activity over the last number of years. But I think the new opportunity now is, the financial activity and the changing asset values, particularly driven by currency fluctuations, and then also stock market moves. I mean, some of the indices, particularly around the world, have been pretty hard hit, and so the public company that was too expensive earlier, is now potentially a more attractive target, particularly with some currency activity as well.
And now we're sort of in this period of transition, you say geographically in terms of financing as well. But in terms of what is it that we'll need to see for maybe stability to come back? I know it's obviously just volumes that are contracting at the moment, but is it interest rates that matter? Or is it, what if we have recession risk picking up next year? What are the sort of things which are going to drive this market over the next 12 months?
I mean, I think most deal makers, as they're thinking about a transaction, they need to have confidence in their business model and the business model of what a combined kind of group might look like. Particularly as we move into recession, potentially we'll see more kind of corporate finance activity, so spinoffs, some activity of kind of right sizing companies, or shedding non-core assets, which is always a hallmark of some of that downturn. But really, the confidence in kind of the market conditions, confidence in the bet that I'm making is going to kind of pay off, and what I'm telling my shareholders or what I'm telling the market is going to actually come together when we do combine these two entities, or kind of make these changes with certain assets.
And then looking sort of forward to 2023 and beyond, is it going to be materially different in terms of how this market feels? Because obviously this tends to be felt like it was a financed market rather than a shares-based market, and also it tends to be dominated by that sort of tech sector. How do you think it will look going forward? Will it be different ways of financing deals? And do you think that you talked about the geographical makeup, but also the sector makeup will come out of this in a very different shape to how we went into it sort of pre-2022?
Yeah, and I think some of the industries which haven't been partaking in the last kind of 2 years of M&A activity are really some of those that were probably more affected by the pandemic, and so consumer, retail, real estate, some of those industries, where we've seen pockets of M&A activity here and there. I think as some of those companies and some of the people, the players in those sectors, can begin to think about what the new retail sector might look like, or what the consumer story is, or what real estate looks like in big cities around the world. You could see some of that really having a big impact. But again, it has been very financing led over the last year or so, kind of based on these historic credit conditions, which are now changing. And so we will see that mix. I think we'll see more shares as part of the bid. Certainly cash, potentially having to either take some cash. Certainly big tech famously has a lot of cash. Although big tech certainly, as you mentioned, has been the hallmark of the last kind of year or so, but also under a lot more scrutiny. There's a lot of activity and regulation around technology companies and the activity that they do in the M&A space. So I think that's going to come into bigger focus as well into 2023.
And then just sort of finalizing all that, I guess, presumably there's still relatively deep pockets in many of these sort of US private equity firms, and given the currencies or generalized dollar strength, do you think that the cross-border landscape will be dominated by US pockets rather than other regions.
You'd imagine that. I mean, it makes a lot of sense. And again, I think the strength with which U.S. companies can come, buying in dollars, will have a big impact. We saw a lot of activity from private equity firms making a lot of acquisitions around the world in that very that post-pandemic quarter as we moved into the latter half of 2020. Private equity was really leading the way, and the big names that you would expect. And I think now the equation might be different, but the cash levels that they have are historic, and I think they can kind of restructure transactions to still make sense, but particularly with the depressed valuations that we're seeing in many European and emerging markets.
So overall, it sounds like it's just basically wait and see, wait for things to settle down, but then actually activity could pick up and become quite strong once more.
I would expect that for sure.
Brilliant. Well, thanks very much for your time, Matt. It's great to talk to you, and hopefully we can get you back on the next quarter to see how those trends are developing. So in many ways, what we heard there from Matt is that this is a sector, the M&A sector, which is in a state of flux along with the market. But I guess the key thing here is as long as the market doesn't run away with itself and disintegrate, then actually there are deep pockets in certain places, particularly North America. And with some of the big moves in the dollar strengthening against many regions, there is a big opportunity for cross-border M&A. I guess one of the interesting things about that is that ultimately, when you see currencies moving like we're seeing, eventually you'll get stabilizers coming in. And some of those stabilizing mechanisms will be purchases from those strong currencies into the regions with the weaker currencies. And eventually we should see some activity probably from the US into places like Europe and the UK if it's not already started already.